Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. By the way, did you get a look at the geese behind me? One's pointing down, which we're going to see in a moment. But the Canadian market is still pointing up. Just a thought. With interest rates rising and earnings results more seemingly random, it's no surprise that investors are worried. And the American Association of Independent Investor survey results, which showed that a record high 59.6% of investors are bearish, may actually be more optimistic than the facts warrant. It's quite clear that investors are no longer being as naive as they has been in recent years, and reality is returning. We do not have to look any further than the FANG stocks to see that these once mighty growth stocks are fading into the realm of myth, and disbelief is setting in. Although some have also taken a hard knock in the head due to some poor results, pounding home a suspicion that the tale may be over. I said last week that last week was one of the most difficult FANG Friday scripts to write, and this week is actually not much better. On Wednesday, Powell gave the market some reason to hope, seemingly, and there was a strong rally. But as investors thought more about what he actually said, they quickly reversed themselves. As of the close on Thursday, the S&P sat right on the cusp of being a sell, while the NASDAQ 100 just shuddered and dove beneath the waves. The FANGs nicely confirmed the NASDAQ by rallying to major breakpoints, almost right across the board, as we will see, and then turning tail and heading south. This week, as per my promise to look at possible investment outcomes for the FANGs, I will review the potential investment outlook for Apple and Amazon. By the way, I would save these analyses, as sometime in the future you might want to go back and see if SVA really knows what it's talking about. However, right now, before we take a look at the FANGs, as always, I do like to say thanks to everyone who likes this video and all our subscribers. Okay, well, first off, Alphabet came down perfectly to its MSG price. That's 5.5 times book value, has had a bounce, and today, even though it was a fairly bad day, or Thursday rather, has a fairly bad day, has set back, although not quite to its MSG price. You know that I have a soft spot for Alphabet, and I am hoping that that the stock can hold here. Meta had just an amazing bounce. It came right down to its SG price. Well, unfortunately, you can't see on this chart, can you? Because we had a new balance sheet there. But if you look back 2 weeks, what you'll find out is that the bottom for the super growth price 2 weeks ago was exactly at $169, which was the very bottom there of that last bar. And the stock has had, well, it's had one heck of a bounce ever since. Remember, I had forecast that this would happen, and boy, did it ever happen. Microsoft has come down to its HB2, which is 12 times book value. It's been struggling to hold there. As of the close on Thursday, the stock has indeed sold off further. And, you know, I've had this stock now as a sell. I don't want it in my portfolio because I believe that the stock is going lower with the NASDAQ 100. Nvidia, same story. it fallen below its HB3, which is 16 times book value. Struggled there, broke out actually on Wednesday, but right back under the line again. You know, when I look at its competition, this is an area, the semiconductors, I wouldn't touch on a bet. Netflix, well, Netflix now is down some hideous percentage from its peak, about 700. And I still don't see that the stock has actually hit bottom as of yet. Again, like the other FANGs, it was sitting just as the NASDAQ was, right on technical support. The stock rallied a little bit on Wednesday, but has fallen right back down again. Remember that I have been expecting that the super growth price was going to give us perhaps a superb buy in the company, and the reason for that is that it has been down here 2 times before in its long history, and both of them are very good times to buy this stock. But let's wait and see for that to happen first. Now, I had said I was going to review 2 companies there to take a look at their long-term outlook, and Apple is one of them. So Apple is sort of swinging around either side of its HB6. Part of the reason that it's been swinging around is because that the market doesn't know, or didn't know at any rate, what the management of the company had been deciding to do as far as share buybacks is concerned. And therefore there has been a fair amount of uncertainty as to where the balance sheets are. However, what I want to do is show you what the long-term outlook of, or the long-term picture of Apple is, and I'm going to put things in perspective. Now, in this graphic here, what I have done is I have graphed the return on equity, which is now the dotted line, not the fair market value, but the return on equity, against the valuation metrics of the stock. And what you see is when the ROE was going basically sideways, so was the stock. It was trading within a range. But once it started to buy back stocks in spades, then the valuation began to move up, and has moved up quite strongly. And the company promises to keep doing that. So I am not prepared to get rid of my Apple as of yet. Remember, some while ago, I actually did a special on Apple in which I said, when the market cap was at $2 billion, and I said, how can we make a $2 billion company into a $4 billion company, $4 billion market cap company? And I said, keep on buying back shares. And that's what the company has done. So I am sticking with Apple right now. The last stock I want to take a look at is Amazon, and not only will I look at it in the short term, but I also want to take a look at the long-term perspective. Here, the stock crashed through its HB1, which is 9.5 times book value. And look at that, when the market itself was sort of buoyantly coming back, and many of the FANGs were going back to their structural valuation breakpoints, and even maybe trying to break out a little bit. Apple, at least Amazon, had nothing to do with it. That is not what I would call promising technical action. You will remember that we looked at Amazon some while ago, and I said, look, here is the 10-year view of the company. And the HB2, which is 12 times book value, had been the bottom for a long time. So breaking that level itself was symptomatic, I think, of perhaps something going a good deal lower. And what's happened is, indeed, that's what's gone on. The the growth of the book value has flattened right out. And when I add in the fair market value, the intrinsic value, that's flattened right out as well. Now the question is, has this ever happened before? In other words, the balance sheet is flattened out and so has the fair market value. I'm glad you asked the question, because it has. And this was back in 2008. And you see here the balance sheet flattening out and the fair market value flattening out. Well, what happened when that went on? Well, Amazon really took it on the chin. And indeed, in that market setback in 2008, it crashed right down to its fair market value. Well, that's very interesting, because where is the fair market value? Oops. It's nowhere near the mid-super growth price, 5.5 times book. It's way down here. In fact, 55.48% down from here. So with the balance sheet flattening out, and so does the fair market value, this is a stock I do not wish to be in for some time while it settles down and we see what actually might happen longer term. Now, in summary, Alphabet is the second cheapest of the FANG stocks, and it's holding at its MSG price, or I hope even better, but that may be as long as the market cooperates. But watch that breakpoint to make sure that it holds. If not, I will admit, reluctantly get out of the way for the time being. The second of the cheap FANGs, which is Meta, Facebook, had a perfect rebound at its super growth price, 3.5 times book, as I confidently expected and forecast, and it has had a spectacular bounce to date. Didn't do you any good, though, did it? You might have bought 3 shares at its perfect low before it screamed off 33% into the blue. SVA shows you where exact lows and highs may be, but in my experience, it is almost as if the whole market knows as well. So you have to act decisively and fast. And no, by the way, I did not tip anyone from BlackRock off. Nvidia points lower. Its semiconductor industry confreres are doing poorly, and I doubt that Nvidia can hold up. If the crypto market really lets go, as I suspect, then that stock drops to levels that you cannot imagine right now. Although, remember, I did show you 2 weeks ago where that might be. Microsoft may be one of the most reliable of the FANG stocks, but it is expensive and it needs a good market to hold it up. And that may be well fading away. Tesla is the last of what I might call the truly messianic stocks, still more or less standing. But its messiah is messing around with Twitter, which is seeing its business collapsing as users abandon the service due to their disbelief and fear as to what Musk may well do. I have a sell on the stock, and I'll keep it there. Netflix has been a dead man walking, although I still expect a rewarding bounce at its super growth price, its usual very long-term low, as I showed you a few weeks ago. History casts a long shadow, and I will tell you unequivocally that the market has a memory which you will ignore at your portfolio peril. Apple is roughly at its HB6, or about 33 times book value, and hanging in, sort of. I noticed that the companies that have been most active in buying back their shares have been holding in fairly nicely in this current setback. I will therefore leave Apple as my one buy hold, and then I will hope for at least a good relative performance. I should, however, quote my late associate, Bob Jones, when I was a partner at Scepter Investment Counsel. He once remarked that relative performance can make for some tough chewing. Amazon's in trouble, as its very recent trend catches the notice of the broad investor sentiment. Given its fair market value measure, these shares could collapse down to their super growth price, which you can't even see here because it's been so long since the valuation was anywhere even close to that low. Unlike Apple, this company cannot buy back its shares. It eats money, and it needs every penny to keep its expansion going. So Amazon should raise some new equity and kind of goose its balance sheet growth rate while the goosing is good. but of course, it can't even do that in current market conditions. So we'll have to sweat this one out, but from the sidelines. Take a very hard look at the FANGs today and their key breakpoints and keep them close at hand. Last week, I said that the whole complex was either teetering or bottoming, but I couldn't provide you with a definitive answer. The market will have to do that. I suspected that it would do that fairly shortly, and I think that the market has now spoken, at least as far as the NASDAQ 100 is concerned. Since we started FANG Friday, events have clearly shown that there are three ways that we can earn our keep with SVA. The first is to help you find stocks to buy. Second, as you've seen with Netflix, I showed you how you can avoid the kinds of big losses that the market can inflict in your portfolio. And third, of course, is to get you into or out of the stock market itself. Now, if you would like to join our investing community and become a client of ours, go to www.strategicanalysis.ca/pricing, and you will see if SVA is right for you. And let me add something right here. SVA is not right for every investor, and we try to weed out those who will be wasting their money taking our service. For now, this has been Ross Healy, Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you all next Friday.